When you are new to the world of investing and you've got some money that you are keeping at the bank, but you know that you shouldn't keep that money at the bank. You know that it's losing value, right? I'm happy you know that already. And so you're looking at investing that money so that you can preserve its purchasing power, but not just that, but also so that it can actually grow. So the money can grow. So you're looking at different investment vehicles. Where should you invest this money so that it can return its purchasing power, at the same time also give you a capital appreciation? You might have heard of unit trusts, like my friend Francis. And so today I'm looking at how do you go about investing in unit trusts? But before you jump into investing in unit trusts, I want to go into the details today and look at why investing in unit trusts could be a viable option or choice for you as a newbie to the world of investing. And so in today's video, I'm looking at how you go about investing in unit trusts with a particular focus on Zambian unit trusts. Let's get started. Hello there, entrepreneurs and investors, and welcome to another insightful episode of the Ndalama Insights Business Show with Mukonkela, where we turn your challenges into actionable insights. If you've subscribed already, a million thank yous to you for subscribing to my channel. Thank you so much to all my subscribers. And if you are new to this channel, you're welcome. Consider subscribing by clicking the subscribe button. It's at the bottom, it's down here. Click subscribe, and thank you so much for doing that. Now let's get started by looking at the actual definition of a unit trust. When you are looking at a unit trust, it's actually a very simple concept. A unit trust is a collection of a fund, or a fund that has different investors that have contributed their cash into that fund, managed by a fund manager or an investment manager. So this individual, the fund manager, is responsible for creating a portfolio, okay, of investments. And these investments could be investments in property, in shares, in bonds, in the money market, in different other investment vehicles or assets. So the investment manager creates a portfolio of an investment. They choose what they would want to invest in, or a combination of these assets, and then the investor or the buyer of a unit buys a share of this portfolio. So you, as an investor in a unit trust, when you get your money and go and buy a unit, you are actually buying a share of this investment portfolio. So it's very important from the onset to really understand a particular unit trust objective. So what is this particular portfolio trying to achieve? Because each portfolio has got a different objective. Okay? And I would also like to remind you, especially if you are new to the world of investing, always start with the objective. I am pretty sure for you to get to the point where you're thinking about investing, you have probably thought about your objectives already, right? Yes. So you know why you want to invest that money. But let's go a little bit further and think about not just the why you want to invest the money. Many people just want maybe to save money so that it doesn't lose value. We don't want to keep it at the bank, right? But we need to go further than that. There could be reasons such as saving for, university fees for your child. Maybe you want to save money to build a house in the next 5 years. You've bought a piece of land. You'd want to build property on that land. And so you are looking at an investment vehicle that will allow you to save money and grow that money in the next 5 years when you start your building project. Maybe you are retiring and you want a regular source of income after your retirement. So those goals are very important when you are considering what kind of investment vehicle to take. Remember, an investment is, we like to call it a vehicle because it's supposed to take you to your destination. So your destination has to be clear. Where are you heading? What is the goal? Because if you understand where you are going, you're going to choose the right vehicle, right? Should you fly to Chingola? Should you drive to Chingola? Should you take a train to Chingola? Okay? The destination determines the how you are going to get there. And therefore, even when it comes to investing, the investment vehicle matches your goal. Okay? So let's go back to the unit trusts. Each unit trust fund has a different objective. There are funds that have got short-term, goals. There are funds that have got medium-term goals. There are funds that are focused on the long term. And with these goals also comes the risk appetite or risk profile of the fund. When you look at shorter term investments, they're normally, low risk, okay? Longer term investments carry a little bit more risk because if you consider the loss in value of the purchasing power of money in future, inflation, and all other economic factors that are not certain. Okay, so longer term investments carry larger risks, if you like. And so when it comes to investments, not just unit trust, really, you also need to look at the risk. And so when you are selecting an investment fund, a unit trust, two things to look out for is what is your goal, what is your risk appetite, and match that to the fund manager's portfolio. A fund manager is an individual, by the way. A corporate is an organization managed by somebody, an experienced investment manager who makes the decisions as to how to invest your money or where to invest your money. But each fund has an objective. For instance, one fund, a unit trust fund that I've come across in Zambia is the Equity Trust Fund, which is managed by ABC. Okay, now this program is not sponsored by ABC, but should ABC Banking love to sponsor my program, and if anyone is watching or anybody knows somebody that works at ABC banking, please get in touch with me. I would love to partner with you. But today, because I think from my research, the Equity Trust Fund managed by ABC has done relatively well, so I think I feel comfortable to talk about it. However, disclaimer, this is not financial advice. Should you seek financial advice in any investment, please consult a registered financial advisor who should be registered with the SEC, the SEC, that is the Securities Exchange Commission of Zambia. All right, good. So that is basically a few things you need to consider as you are starting this journey of investing in unit trusts. Now let's go back and look at who are the key players when it comes to the unit trusts. There are certain key players that you need to be aware of. The first one is yourself, the investor, you who's buying the unit. The second one is the fund manager. You've already known the specific role of the fund manager, right? They're the ones that get the money that you've put in that fund and select specific investment assets that they are going to invest in. The third one is the trustee. The trustee is the custodian of the assets that you're investing in. They are different from the fund manager, okay? And finally, we have the actual custodian who actually holds the underlying securities of that trust fund. So there are essentially 4 key players that you need to be aware of, okay, as you go about investing in unit trusts. Now, you need to know that unit trust funds are regulated by the Securities Exchange Commission, that is the SEC, and all fund managers are actually registered with the SEC, and you can find their names on the SEC's website. So go to the Securities Exchange Commission of Zambia's website and you'll be able to find a whole list of trust funds as well as investment managers. So now, how much can you invest in a unit trust? How much can you start with? Well, that all depends really on the kind of fund you want to invest in and the options that are available on the market. From my research, there are different funds allow you to invest a lump sum amount, okay, and then others have a minimum amount that you need to start with, and then you can make monthly contributions towards, that fund. It's also important for you to know the price of the unit. Each unit has a specific price, and you get that information from the trust fund's website, or you go to their offices and ask for a prospectus that details the price and the costs and expenses and other things that I'm going to talk about later on. However, when you're starting to invest, it's important you find out the price of the unit. And when you find out the price of the unit and you know whether that fund allows you to do a lump sum investment or monthly installments, you can then calculate how much units you are going to buy in a specific amount. So for instance, the Equity Investment Trust by ABC Banking allows you to do monthly installments of 2,000 kwachas. You can also do a lump sum of 20,000 kwacha into that trust. So if you say, I'll be making monthly contributions of 2,000 kwacha, you need to divide that by the price. So if you go to the ABC Trust website, Banking Trust website, you are going to find the prices for all their unit trusts. If you look under the Equity Trust Fund, you see that the price for September, I think 9th September, was about 1.60 kwacha. So you can buy that trust, a unit, at that price. So if you are making monthly contributions of 2,000 kwacha, you divide that by 1.60, you're going to get 1,250 units. So those are the units you're going to start with if you are starting with 2,000 kwacha. And every month you keep increasing your investment until you get to an amount that you're comfortable with investing. So that is how you basically determine how much you can invest and how much you can start with. So there are two options. Essentially, you can start with a lump sum or you can do monthly installments. And the best way to do the monthly installments is to do a deduct, that is a direct debit from your account to the fund manager's account, and then they can manage that investment. They can buy the units for you, or you can get the units in that fund. So how do you actually become a unit trust holder in any unit trust? You need to fill in an application form, and fund managers have got application forms which have got I think similar things or requirements. Maybe there could be a few unique items, but generally you need to fill in an application form. You state the fund that you want to invest in. Is it an equity fund? Is it a money market fund? Is it a fund that looks at bonds? Is it a fund that looks at a property? So you need to state what kind of fund it is that you want to invest in, that this fund manager is selling. And once you do that, you need to also give them your proof of identity, or identity card, passport, or NRC, or reg. So give them that proof of identity. Also your proof of residency. You could get a letter from your employer. You can have a lease agreement from your landlord. So give them your proof of address as well. And some also ask for passport size photos, maybe 2 passport size photos. So once you complete the form and you have all these documents ready, you can take them to the fund manager, and they should be able to process it quickly, isn't it? I hope so. Yeah. So then you become an investor in unit trusts. Let's talk about the costs. You see, when you are investing with a fund manager, when you are buying unit trusts, you are not actively managing your portfolio. Somebody else is doing the managing of the portfolio or investing on your behalf. So it's more like you've delegated your investment to another person. Okay, so it comes with a cost. It's not free of charge. It comes with a cost. They are going to charge you something, and normally the costs of investing in unit trusts are computed on what is referred to as a net asset value basis. So there are generally three kinds of costs that you expect, and these are shared costs. It goes to the asset value of the entire fund. So the costs are computed based on the net asset value of that fund, and then it's shared. Remember, this is a collective investment scheme, so you share the benefits, you share the risks, you share the costs, right? Those are the advantages of actually investing in a unit trust, other than the fact that you're also getting expertise, okay, from a professional investment advisor who's had experience, who's trained in choosing, investments that will give you a desired return. And so the three costs that you need to look out to are administrative fees. These are fees that have to do with maybe holding annual general meetings, or having the fund audited and all of that. You need to look out to regulatory fees. These are fees that allows the fund to be in compliance with the Securities Exchange Commission's rules and regulations. You also need to look out to management fees. These fees allow the fund manager, basically this is where the fund manager gets their payment from. And so the charges are different. You need to consult your fund manager with regards to these three costs. At least you know the major headings. So we've got the administrative fees, the regulatory fees, and the management fees. Go and find out the actual cost. I believe for the ABC Trust, the administrative fee is about 0.8 something of the net asset value of a specific, fund or unit trust fund. So you need to ask those questions. It's very important you understand the cost because it has an impact on your return. All right, if you are enjoying this video so far, don't forget to give it a like by smashing the like button below. And if you've got any questions already that you feel are not answered, please leave a comment in the comment section below. And don't you forget to subscribe by clicking the subscribe button. It's down, it's at the bottom, it's down here. All right, now let's move on to the most exciting part of investing in unit trusts. How does a unit trust make you money? As an investor, you always need to ask yourself this question. It should be top amongst the questions that you ask yourself. How does this investment make you money? So when you invest in a unit trust fund, there are generally two sources or two ways in which you make your money. The first one is income. Now, the income you get from your investment in the unit trust depends on the kind of investment or the assets that are in the investment portfolio that is managed by your fund manager. So remember, a fund manager is going to create a portfolio of assets. It could be equity, shares, or property, or a combination of these. The income that you get, for example, from property is rental income, isn't it? So, as a unit trust, holder, you're going to get rental income. If the fund is an equity, trust fund, we expect you to get a dividend income. Right? You're getting it, isn't it? If your investment is in a fixed income instrument, such as a bond, we expect you to get regular coupon incomes. Right? So the kind of income you get by investing in a unit trust depends on the assets that comprise the portfolio that is managed by the fund manager. So it's extremely important that you understand what assets make up the investment portfolio, because the kind of assets that are in the investment portfolio results in the kind of income and how frequent it's going to be. Okay, so that is the first type of income, or that is the first kind of money that you make by investing in a unit trust, its income. And this income is normally netted off by withholding tax and handling fees. So you get a net income after deduction of withholding tax and the handling fee. So always know what the withholding tax charge is on the type of income. What is the withholding tax percentage on dividends, on a bond, on the share, on the dividends? I've already mentioned dividend shares. Okay, so you need to know what the withholding tax is and the handling fee, and that will help you to compute how much the net income you'll be able to get. Should you decide not to, get that income regularly, you could decide to reinvest that income in the unit trust. So you buy more units. This is good because the reinvested, income is going to result in, an increase in the value of your investment. So in this case, the money that is being reinvested is going to be used to buy more units at the existing unit price or price for that unit. The second way you make money from unit trust is through capital appreciation. So capital appreciation is where you bought an asset for a price which is lower than its current existing price. So if the price of your investment or unit has gone up, that is a capital appreciation. Okay? So it means that the value of your investment has gone up. So for example, if this trust fund is in property and we expect that prices for property are going to go up, it means that there's an appreciation in the value of that property. As a result, there's a capital growth on your investment in that trust fund that has invested in the property. Also, when it comes to shares, if there's an increase in the prices for the share price or the share, it means that there's a capital growth in the equity investment in this share. And so the other way you make money from unit trust is through, capital appreciation. Inversely, it's also right to say that you lose money when, maybe property loses value or a share price comes down. So you also need to look at the other way or the other side. You could also lose money if, the value of the properties on the property market are coming down, which is quite rare or very unlikely when it comes to property. And generally, property values keep going up. With the shares, it's a little bit uncertain, and so you also need to check, because you could actually be losing capital if the price of the shares are coming down instead of going up. So these are the two major ways in which you make your money by investing in unit trusts. Now, finally, can I sell my investment in the unit trust? Of course you can. Of course you can. So when you decide that you want to redeem your units or you want to get your money, you can sell your units, and you sell these units from the fund, or company where you bought these units. Okay? So you go back to your fund manager and tell them that you want to sell these units, and they will help you to sell these units at the existing market price for those units. One more thing that I forgot to address is what affects the prices of the units. How are these prices determined? It's a very important question for you to consider, and I would like you to go to do further research by asking whichever fund, unit trust fund you want to invest in. But the prices for units are determined by the nature of the asset. Okay, so if it's a share, it's the share price that will determine the price of that unit that you are investing in a equity trust fund. Okay, if it's a bond, it's the prices for the bond that are going to determine the price for the unit that comprises that investment in the fixed income unit trust fund. If it's a property, it's the prices of whatever property on the market. So it goes on like that. So the prices of units also go back to what kind of an asset investment is it? Okay, and of course other factors are also considered, so go back to your fund manager to find out further information in terms of the pricing of the unit. Well, this is all I had to share in today's video. Thank you so much for watching, and I hope, Francis, I covered most of what you wanted me to cover. If not, and if you've got further questions, please don't forget to drop your comments in the comment section below, your question, your comments. And if you like today's video, don't you forget to smash the like button and also share this video. If you've subscribed already, a million thank yous to you. If you haven't subscribed, consider subscribing by clicking the subscribe button. It's up here. Click subscribe, and also don't forget again to smash this bell icon. Thank you so much for watching, and see you next time.